Welcome to the Real Estate 401k Show. Here are your hosts, Ryan Gertis, Mike Weinstein, and Justin Frederick, helping you build a legacy of wealth through real estate. Powered by the Recon Group at West USA and the Frederick team with Fairway Mortgage. NMLS number 625918.
You know, years ago, Justin, when I really got started in real estate and people would ask me what I did for a living, I'd always tell them that I'm a real estate problem solver. And that would always lead into what that means, because in order for me to do my job, or first of all, I should say, I recognize that my job is solving people's real estate goals, solving their needs, meeting their needs, and solving their problems, whether it's I've got to have a house with a pool, whether I've got to be in this school district for my kids, or I've got a baby on the way and I've got to add, I need another room. And so for us, we're just trained. We listen, we ask the right questions, we try to figure out what problem needs to be solved. And I think we're really, really good at that. One of the problems that we face, especially more so 2 years ago, but especially also in this market, is I'm a seller and I want to go buy, I know I need to sell my house and I need to go buy another house. However, because of the competition, it's hard for me to buy that other house on a contingency, getting that seller to say, yes, I'll accept your contract contingent upon you selling your home that you live in right now. The problem comes is, well, if I don't want to sell right now and I don't want to buy a house on a contingency, how do I get the cash if all of my equity is in the house that I'm selling? And so how can I not have to sell my house immediately? How can I buy home number two, not contingent on the home of sale number one, and pull my money out? And that is called a bridge loan. So walk us through what a bridge loan is and how that works.
So it's a really cool product. What it does is it takes the equity in your current home and it uses that equity for a down payment on the new property. And it allows you a certain period of time. In most cases, it's 6 months in order to sell your current property, buy the new property. And we would only have that loan go into effect once you actually were under contract for the new property. So typically 30-day close of escrow, right? But that loan goes in effect once you close on the home. So then you would have 6 months to sell previous property, right? Now, credit scores, qualifying, debt to income ratio, all that is considered into there, and they leave room for your expectation on what you can sell the house. So they leave equity there to make sure that if you need to get aggressive and lower the prices, or the market drops a little bit and you need to sell that house, it gives you room to sell the home. But the cool part about it is it gives you the convenience of keeping your current home and not having to be packed up all in the same day and make that move. These loans were around back in prior to 2008. These were very common loans prior to 2008, and they just recently started coming back. There was a company called Knock that's come in, and we actually partner with Knock too, so we do those loans as well, but we also have our own bridge loans.
Well, we used to partner with Knock until you started producing bridge loans, and so let's just keep everything in-house, right?
Yeah. They have some options. Sometimes they will give a better value on the property so that we can possibly get more money there, so we'll search it out. But a bridge loan is basically bridging the equity from your current home with the equity that you have into the new property, and allowing you to do that without having to do a recast or anything like that on the new property, to allow that equity to just flow over to the new home.
All right. If you would like some more information on bridge loans, we'll make it really simple. All you got to do is text the word bridge to 623-AZ-RECON. That's bridge to 623-AZ-RECON. One of the things, I know there's just been a lot of talk, a lot of chatter on social media and in the news, and I always like to remind people that just because certain things are happening in different markets, real estate markets across the nation, doesn't necessarily automatically mean it applies to the Phoenix metropolitan area. And I know rates are high, and I know people are saying that homes are sitting and that the market is slow. It's not true. Homes are selling. there's still a lot of competition on a properly priced house.
Correct.
Out there, and we're sometimes, when we take clients out, sometimes we're still in multiple offers and so forth. So people need to understand that, and so that is why the bridge loan solves a huge problem. Because again, because the market is still pretty strong, and it also depends on price point. Because the market is still pretty strong, sellers do not want to accept contracts that have a contingency unless their house has been on the market for a very long time. So that again is the problem that it solves. The other problem that it solves, because what a lot of people would do in the past, Justin, is okay, I need to pull because they don't know about bridge loans.
Mm-hmm.
So I need to pull the property out of home number A, my primary. I can't get a seller on property number B to accept my offer based on a contingency. So what we would often see them do, sell their home, put the money in the bank, go out shopping, but now they've sold their home. So now what do they do? And a lot of times then they're entering into Airbnbs and midterm rental situations, and it can be an incredibly stressful period. And I think you brought up the best part, is if you get the bridge loan and we go out shopping and we find another house, you still haven't packed a thing.
Yeah.
Right? You can still go through the inspection periods and all the negotiations and close escrow on the new house.
It's a convenience factor.
And then we put home number A, your primary, on the market at that point.
Yeah, and a lot of people just go after it just for that convenience portion of the product. But yeah, it can be extremely stressful depending on how you deal with stress like that. But I feel like majority of the people that are going after these types of products are people that don't want to deal with all that stress at one time, want to reorganize their house once they get into the new house. They don't want to just throw it all in boxes and unpack the boxes. As they want to move in portions and have that house laid out exactly the way they want to lay it out, to where they know where everything is immediately, and it makes sense to me. And also, I mean, I feel like you're the professional here when it comes to this, but I feel like
that's one of the nicest things you've ever said about me. Thank you.
You're welcome. I believe there's a statistic that says that when your house is empty and staged, you can most likely get more money than if you have all your personal belongings in the house.
And that's true. There's it kind of goes in order of preference. A occupied home that is full of clutter is the least desirable. So there is a way to still occupy a home, put all non-essential items into storage. Mm-hmm. But number two is taking a vacant home and then just staging it. And then number three, then, of course, is just the vacant home. The other thing, and walk me through this, so let's say I do a bridge loan, and I know that when I buy property number two, and assuming I got enough equity, and I know I want to do $15,000 worth of flooring and painting before I move into it, through the bridge loan, can I take some of that equity and do that before I move in?
You can. You can. It allows you to, some of these bridge loans will allow you to do work on your current home, and they'll allow you to do work on the new home with the money that you're borrowing.
All right, if you'd like some more information about bridge loans and the convenience of them, we want you to go ahead and text the word bridge to 623-AZ-RECON. That's bridge to 623-AZ-RECON. Might catch you off guard with this question. So I get a bridge loan. And let's say I take $40,000 out on the bridge loan, buy home number two. Now I'm going to sell home number one, but I have a change of heart. I go, you know what? I might just want to keep home number one and turn it into an income-producing property, but I've already taken $40,000 out.
So that does throw me for a loop right there. But I would assume, and I feel like my assumptions are pretty accurate, that we would have to be able to turn this into an investment property. So it would have to be a cash out investment loan. Now, typically, we're going to allow the bridge loan to go up to 80% loan to value. If there's any thought in your head of doing something like that, we'd want to keep the loan to value below 75%. Yeah. So we could do that cash out. And that's a conversation that we'll have with you up front too, to make sure that that's doable or that we're on the right path and our plan is pretty much set in stone. But this does happen. People do change their minds. Now, typically, if somebody has any thought of changing it into an investment property, we'll talk about HELOCs rather than a bridge loan, just because that's probably going to be more advantageous based on what rates have been for the last decade, and what that can provide them as far as ROI.
You had mentioned earlier, and I think it's another great option to talk about. This is a very common discussion that I have with a lot of my clients and a lot of our podcast listeners. Obviously, we always go in with the intent to talk you out of selling your home, because oftentimes that home is going to make a great income-producing property and a great asset included in your real estate portfolio, but not everybody wants to do it. And maybe they just don't like the fees or whatever the case is of the bridge loan. They even just have the cash already to put down on home number 2, but they would love to also be able to take the equity out of home number 1 when I sell it and then add it to that down payment at a future date. And we call that recasting. I'm amazed that so many people have not heard of that. But it's a conversation I have on a weekly basis of being able to recast your loan. Walk us through that.
Recast is very easy, and it's very cheap compared to every other product that's available out there. So a recast is very simple. Basically, typically a servicer wants you to wait 12 weeks before you can recast the loan. Now, you need to put a minimum of $10,000 additional towards the principal balance of the new property in order to do the recast of the loan. And again, each servicer is different. So you want to make your lender, and a lot of lenders don't know about recasting, but it's easy for them to research. So they need to research.
Well, okay, let's just stop there. If you're listening to this podcast and you go to your lender and you want to learn about recasting, and he says, let me get back to you, I need to Google that. Or she says, I need to get back to you and Google it. I'm telling you, run. Because it just tells you the level of competency and understanding of all the different options out there when it comes down to 100%. Lending practices. So you didn't say it, but I can say it.
Thank you, sir. I appreciate that. So basically, typically it costs about $350. Now, those fees will vary over time. They've changed dramatically. It used to be $500 and one would be $200. Now they're pretty much equal, about $350. So you'll call the servicer after 12 weeks of the loan origination, and you're going to say, I want to recast my loan. They're going to send you out a document. You need to fill it out, say how much you're going to put into it, whether that's $100,000 or.
So for simplicity, terms, you're basically adding a second down payment.
Correct.
Or adding to your original down payment at a future date.
Correct. And if let's just say you're doing $100,000, well, they're going to reduce your principal balance by that $100,000 and re-amortize your loan, so your monthly payments are lower at the time you have remaining. So if your
interest rate does not change,
the terms of your loan do not change other than the recasting or re-amortization of your loan. So your principal and interest payments will be lower based on the new note amount that you have, and it just recasts it over the time period you have remaining. So if you have 357 payments remaining, you'll have 357 payments remaining at the new balance.
And my understanding is you have 12 months to do this typically, and you can only do it one time.
You can only do it one time. Now, I've had people do it after multiple years.
Oh, really?
So again, it depends on what the servicer.
Okay, let's talk about that. So now all of a sudden, I don't want to, I got a 3.5% interest rate. Obviously, I don't want to touch that 3.5% interest rate, but now all of a sudden, I come across $50,000, $60,000, $70,000. I can recast it then at maybe more than 12 months down the road, and now my monthly payment's going to be really good because I still got a 3.5% interest rate.
So yes, but I'm going to tell you, if you come across $60,000,
you're right,
and you have a 3.5% interest rate, buy another property.
Yeah, that's a good call right there. That's why That's why you're on the big show every week, right there.
Appreciate it, man.
All right, if it's really all about creativity, especially when it comes down to loans and lending and things like that, and we work with the very best, you just need to work with somebody who is incredibly creative, who understands all the programs, and I would dare say is a very, very savvy investor himself. It's one of the reasons why, and I know I throw some stuff out. Because when I wake up in the morning, I see the world in gray, right?
Yes, you
But
do.
the conversations and the creativity that you and I and Ryan, God rest his soul, not that he's dead, he's just not here again today, that we have, it's because we can have these conversations based on shared experiences, shared goals, and I don't think I would ever, even if I bought a house I know you're in a lot of states, but even if I bought a house in another state that you weren't able to get me the loan on, my first question, I have three questions for the lender. Number one, how long have you been doing it? How many loans have you done? And are you an investor? And if you're not an investor as a lender, I don't want to, I don't want to talk to you.
Yeah.
Because we're not on the same page. Anyways, there's so much creativity that goes into it, and I want to introduce you to Justin and his team, the Frederick team at Fairway Independent Mortgage. All you got to do is text the word BRIDGE to 623-AZ-RECON. That's BRIDGE to 623-AZ-RECON.
Thank you for joining us on the Real Estate 401k Show. If you want more information on how to build wealth, click on the link or text us at 623-297-3266. That's 623-AZ-RECON.